Let's quickly also move into the stock impact of Adani on Adani group of companies. As far as those allegations is concerned, let's quickly pull up those stocks. Meanwhile, let me also invite our guest Rohit Srivastava, founder, Strike Money Analytics and Indiacharts, joining us on the show. Rohit, we are discussing the ongoing, an investigation that was in fact carried out by Financial Times, released yesterday. And so far as this morning is concerned, we are looking at Adani group of companies, all of them in the red. Do you think investors are reading closely to what is happening by the way of these allegations, or are there, very different sort of reasons for a downward movement in stock prices?
No, definitely there is a sentimental impact whenever there's news flow. This is, I think, a second one because there was also a news item related to some allegations at the end of August on expiry day, and this is now a follow up on that. But all this while we are all waiting for the final note from SEBI in terms of what investigation it has already done. I think that will be the final take. You're really not seeing the kind of panic we saw the first time these reports came out in January, when these stocks were falling 20-30% and eventually ended up losing significantly. Today's reactions will appear more like a knee-jerk one-day reaction because already the last report sort of almost gave a clean chit. But the main area of investigation is not what happened, in the Indian operations, but what was happening through these, companies that are outside our borders, and that investigation is the slightly more difficult one. So we'll have to really leave it for the authorities to do so. In the meantime, the reactions will be knee-jerk. They do definitely affect sentiment on the street for the day. But I think markets beyond that will have to start focusing back on what is the start of an earnings season, where expectations are, for a 20% earnings growth for this quarter. And I think that will play on the positive side of the other stocks that are in the index. I think the pull down really comes because of the Adani group being in, so many NSE indices. If they were not there, it would have been easier in terms of sentiment for most investors. But I think that's the overhang really, that they're part of too many indices right now.
Looking at data right now, good morning, Kartik here. Looking at data right now, in fact, Adani Enterprises is now down about 3% and is among the top losers on NSE this morning. So, I think, is it the start of another selling cycle, or do you think it is going to stabilize now at this down 3% odd levels? Because markets have been open for about almost an hour or so now.
So I think nothing has happened to say that it is going to become something bigger, because if I simply look at a chart of Adani Enterprises, it would not have broken the 10-day lows also. It's just fallen back after it's moved up a bit. So it's just giving back some of the gains it made earlier this month. So in that sense, it doesn't look so bad at this point of time.
Okay.
So it would have to probably fall a lot more for us to say that. And then today's market decline is also associated with Infi's earnings yesterday. So it's not only because of the drop in Adani stocks.
That's right. So while you're talking about Infosys, Rohit, what is your reading into the IT sector? We've seen TCS results, we've seen Infosys results, we've seen HCL Tech. What is your understanding, your reading so far on the print coming out of IT earnings? And now in the context of war, possible inflation impact in the US, discretionary spending likely to be cut, business in IT sector likely to reduce, fresh guidance issued by Infosys at a lower level. So overall, how are you reading the IT story?
So, you cannot get bad news at the top and good news at the bottom.
Okay.
So you have to really think about whether bad news is discounted. If you look at the behavior of the IT sector in the last quarter's earnings season, it was rather positive. In fact, after the result season kicked off, most IT stocks actually rallied after some initial reactions. Because last year we've already priced in a lot of the slowdown that we are seeing this year. And I think that will continue to be the case. So you may see a knee-jerk reaction like today, but if you also look at the books of Infosys in terms of the orders gained, that there's a positive side to it as well. So I think the reactions will be more short-term. But having said that, growth is definitely slowing down, which means that the pace at which we've seen some of the large IT stocks go up in 2021 post-COVID, that pace may not continue and that is what we are seeing. We are seeing a very slow advance in the sector, not the same speed as before, except in particular individual names in the mid cap space, which are really high growth stocks. So we would really come down to stock specific analysis. The worst in the sector is priced in, but it may advance less slowly. So in that sense, would I really allocate significantly to the sector? Only maybe in individual stocks, but not in general. IT would not end up being a major allocation. I think as far as an Indian portfolio, there are a lot of other places which are growing at a much higher rate.
Okay, and this higher for longer commentary by US Fed, which means there is going to be higher pressure on US companies in their sort of orders coming into India. So overall contribution of IT, and then even the other report we saw the other day of 2025 being a washout year for IT. Is the world reading too much into the IT story? Like you mentioned, it's not going to be one of the heavyweights, heavy lifters of the economy, but is there too much focus on the IT sector? Are we reading too much into it?
See, one thing you have to accept that IT is you cannot really do without IT, whether it is in the form of services which are providing, back-end help, or whether it is in the form of products. Our world is running on IT, and now with the advent of AI, even more. So IT is not going anywhere, and then in that context, if you look at the US, is it growing or is it contracting? Yes, there's a lot of negative news flow, but if you look at S&P 500 earnings, for the last 3 quarters, it's been sort of 1%, 2%, 3%. Nothing great, but it's not negative. It's not like you're seeing earnings drop 20%. And so that simply means you have stability. You just don't have growth because of the tightness. And simultaneously, you're entering a quarter in which government spending is going to be picking up now that they have done away with the both the debt ceiling and the shutdown. A lot of spending is going to take place, which will eventually drive some level of consumption and growth in certain sectors. So you will see US equities in general start doing well again. That is my sense, at least over the next quarter. Okay. How much of that translates into Indian IT business growth is the tougher call, because if the US is growing very slowly, business growth does take a hit, and that we are already seeing, right? We are seeing it in terms of the slowdown in growth. So that's the broad picture. I don't think things are extremely bad as far as the US is concerned. They are in a tight spot, but you have government support in terms of spending, which is going to keep the growth momentum in certain areas, and that's the upside.
All right. And I want to talk about global markets, but before that, Indian markets opened in the red this morning, 0.5% down as of right now. Do you think the IT pack is pulling, the indices? The IT pack in itself was down about 1.3% last evening. Overall, what is the sentimental impact of IT companies reducing their guidance, pulling back as far as hiring more people is concerned? Despite mega deals that we have seen being announced over the course of last couple of weeks, there doesn't seem to be much of a traction on ground just as yet. I understand these are long-term future contracts, but when can we see an uptick?
So I would say I would not bother too much about IT. See, most asset managers have actually reduced their allocation towards tech. It's one of the sectors in the index, but there are many more. So if you look at earnings growth for the Nifty projected by most of the brokerage houses right now, trailing somewhere between 22 to 25% for this quarter. Last quarter, we delivered almost 30%. Now, with that kind of growth, you have to only answer one question. Where is that? If it's not in IT, it's somewhere else. It's in banking, it's in infra, it is in so many other areas. You'd end up allocating your money there in those different sectors apart from IT. So you go underweight IT, you go overweight something else, and things move along. That's, I think, the way we are going to really approach this whole thing. But definitely on a day when IT earnings have been announced and there's a 4% drop in Infosys stock in the morning, then it does have a sentimental impact on the day's opening. We've seen the index drop to 19,650 is, I think, the support level. We've stopped there, we've bounced back a bit, and I think as long as we hold these levels, things should stabilize and move ahead from here.
All right. And as my colleague pointed out, there were projections that IT is going to be a laggard. And as soon as the earnings season kick-started, we've seen markets reacting to that. Do you think the volatility in the upcoming weeks continue as more and more results are declared? What are you making of how markets are anticipating results from the IT sector? Because that's where it starts.
No, so it always starts with IT. But what I'm trying to highlight is that once other sector earnings start kicking in, then you start getting the upside downside balance, right? Like the weakness from IT versus the upside from other sectors balances out to a much more positive versus negative, because if overall average earnings are going to grow at 20, 22%, 25%, uh, the upside is going to take over the
Okay.
downside from IT.
So, Rohit, is it fair to assume with all the data that we've seen, record car sales, record house sales, FMCG sales, the festive season
Consumption.
consumption story, I think everything overall is adding up well when it comes to India's consumption and the fact that Indians are saving lesser, investing more, as we've seen in the Amphi data on SIPs. So overall, do you think whatever we are seeing as a inflation impact on IT, the global inflation impact on IT, will be more than offset with results coming in the auto space, results coming in the FMCG space? Is it time to be not cautiously but really optimistic about the rest of the consumption story in India?
Absolutely, I think that's the nail you need to hit. That you have consumption, you have savings, you have investment. All of them are kicking in. We should not get bogged down by one particular sector's performance or one particular theme when there are so many things working in your favor. Focus on the areas that are really working and invest in that. Sort of, we also call that momentum investing. Where is the trend? Where is the strength? So we look for strength and we bet on strength rather than bet on weakness.
Okay, and if I can ask you specifically about the auto pack, are we likely to see some impact of the EV sort of mobility rush that we are onto right now, where companies that have EV vehicles will be better poised to grow going forward as compared to even companies like Maruti Suzuki that don't have an EV story just yet?
It's tricky because EV is a slow moving long term trend. The adoption is definitely taking place, but by the time everybody starts buying EVs and you have charging stations and all that process, it's a long drawn haul. It's also that it's not going to replace the entire market, right? It's going to be a certain percentage only, and so we have to think of it that way. We can't really downgrade a particular stock because its exposure in EV is low at this point of time. It may be too early to say that, because like I said, it's not like there's going to be a complete switch over to EV from classic vehicles.
Okay.
Okay, and another sector that we're tracking very closely is realty. Realty is also picking up momentum as we move into festive season. More people looking to buy not just affordable houses but also high-end luxury houses, and the stock impact is also clearly visible. What is your assessment of how realty pack, will perhaps how will it perform going forward into the future?
It's making a very interesting comeback. So if we actually look at 2021, realty sector was really not doing so much as many of the other sectors, including IT, metals, etc., were doing far better than realty. But if we look at this particular year or the last quarter, we actually seen a pickup. In fact, just if we take the last 2 weeks also, in this bounce back of the market, the first sector showing strength was actually realty. So there's clearly an interest in the realty sector with the improvements that you're highlighting, and I would sense that it does well. It probably does pretty well now at this stage in the cycle where people are beginning to, get back to buying homes from other spending patterns.
All right, and before we let you go, all global markets, in fact, ended in red. Hang Seng, Dow Jones, S&P 500, also on the back of the inflation data, the much-awaited September US inflation data that came out last evening, Thursday morning for the US markets. What are you making of inflation? There wasn't a steady increase or decrease. It's a sense of status quo. Although US Feds were factoring in that the constant rate hike cycle will factor into US inflation, perhaps bring the numbers down. That hasn't really happened. What are you making of these numbers?
So, interest rates in the US do have a limit. You cannot raise them beyond a point given the size of the credit out there. So, if they do keep going up, at some point the Fed steps in and starts buying those bonds, and then you get something which is known as yield curve control. Now, we're not there yet. They've not stepped in. They haven't done anything as of now. They're probably letting the market do its own job. But as far as inflation is concerned, it is a lagged data. If you actually look at certain prices, for example, I was just looking at wheat prices. They're down significantly from where they were, last year when the Russian crisis was at its peak. a big drop has happened in prices of wheat. We haven't seen coffee prices go back to the highs, or soya bean prices go back to the highs. So a lot of commodity prices which are behind inflation are sort of stagnating. We've seen oil drop from 135 back to 70, and now it's back to 80, 90, right? So we're not at peak prices anywhere, but it takes time for inflation to really show that. What we're really looking for is that, does it really come back? And if not, then you'll probably slowly, steadily see inflation inch lower over a period of time. If it's slow, it's going to make policymakers hold on to those higher rates for longer, which is what is going on right now.
That's right.
But the real answer is going to come in whether you are going to slow down growth. Now, the catch here is what I mentioned right in the beginning. Governments are spending, which was not the case between 2010 and 2020.
That's
In
right.
the post-COVID world, government spending, not just in US but also in India, has picked up significantly and therefore become a great stabilizing factor when it comes to growth. And that is what will keep markets from getting impacted very significantly from the rate environment.
So, if you were to talk about specifically, since we are talking inflation and we are talking about the government spending, is it fair to assume that for the foreseeable future, Rohit, the heavy lifting for growth, for India's GDP growth, will be done by government spending, infrastructure, capex spending, or are we actually going to see perhaps post-election and once we are hopefully in a lower rate cycle, the corporate India capex also pick up? Because that has been elusive for as long as I can remember now. I think since COVID, the economy has really only been thriving on government doing the heavy lifting.
Yeah, so one of the forecasts that I have is for Indian rates to actually go down a lot, which will only happen once the global pressures ease a bit. Once moment you see that easing in terms of the pressure on the US bond market, I think bond yields in India probably drop a lot more. And that will make corporates feel far more comfortable in terms of doing the investment and getting into the investment cycle. So once you start seeing credit growth, it's usually once it picks up and once the momentum, comes in, what we also call as, uh, you know, uh, not green shoots, but I'll say, animal spirits, like, right? So once animal
Yeah.
spirits really kick in, then that really continues as a pattern. Till that doesn't happen, governments are going to play an important role. Also, remember, as we enter the election year, most governments are going to keep spending high, simply from the point of view of an election. And that also aids the underlying momentum as far as markets are concerned. So there's going to be that spending. But yes, once rates in India do start easing, you will see the corporate sector invest even more and the credit cycle pick up, which would then make things look much better than they do right now.
But Rohit, how insulated do you think India is going to be from what is happening in the rest of the world? Because we've seen, I mean, we had retail headline inflation coming on account of very high food inflation and vegetable inflation. That has eased off. So while numbers have come to 5% levels on headline inflation, we've also seen that core inflation, which strips off, energy and food prices, is not sticky anymore. So India specific, we've seen even core inflation now tapering down. So will we see a rate cut possibly as anticipated by RBI earlier than FY25, maybe in Q4 of FY24 itself?
And given that, the September inflation data has beat all estimates.
Absolutely.
At 5%, I think everybody that we've spoken to so far in the last 3 to 4 days suggested a 5.4 to 5.5% range. At 5%, I think it beat government estimates. If that remains, if that trajectory remains in the upcoming months, are we looking at a rate cut sooner than expected?
I would have liked to say yes. If you ask me, I would like them
We've
to
been
cut
waiting for a yes.
more.
Nobody says a yes, Rohit.
Yeah, but I think they're trying to really weigh in what is happening around the world. I think that's why they're not doing it right now. Inflation in India has been at a much lower level than around the world if you just look at the differential. And that has caused interest rate differentials also to narrow down significantly. We've really not seen the difference between Indian and US interest rates at this lower level
True.
ever before. And
Right.
that is because we are in a better position. But can we really cut rates? Because the interest rate differential also plays a role on your currency. RBI doesn't admit it. They don't want to say that rates are being used to manage the currency, but it does play a role because if you allow the difference to remain low, your currency will remain under pressure, which then puts pressure on the RBI to keep
Right.
selling dollars and keep the currency from running away. So that's probably a reason to let rates remain higher for a little longer as well till the global scenario eases. But moment that eases, I think we would be in a good spot to start cutting rates fast. But we are not there yet. So I think yes, it's going to be a waiting game for our own rates to roll over. The case exists, but the
Right.
timing is really the issue.
All right, Rohit, thank you very much for taking time out, sir. Thank you for joining us here on News 9.